Hello, everyone, and welcome to the Basepoint Wealth Investment Update and Outlook webinar. My name is Katie Ortgies, and I'm the Director of Operations and Chief Compliance Officer at Basepoint Wealth, and I am your webinar host today. We thank you for taking time out of your busy schedules to join us, but before we get started, I have a few housekeeping announcements. To protect your privacy, all participants will remain muted for the entire webinar. For those of you joining us via web conference, at the bottom of your screen, there is a Q&A icon. We will have a brief question and answer period at the end of this call. If you have a question during the presentation, please click the icon, type your question in the window, and click send. Whatever questions are not answered during the call, we will respond personally offline. If you are joining us via phone, or if you have a specific question about a holding in your portfolio or an aspect of your financial plan, we encourage you to contact your advisor directly, and they will be happy to answer your question. This webinar is being recorded. We do have a brief disclosure slide, which you can review in further detail when the replay is made available. Without further delay, I pass the mic to Alan Wallace and Landis Wiley to begin our presentation.
Thanks, Katie. And thank you to everybody who's taken time to join us today. We know that you have lots of things to occupy yourselves throughout the day, and we truly appreciate the opportunity to share with you the thoughts of Basepoint Wealth and our investment team on the current status of the investment climate, as well as our portfolio management. My name is Landis Wiley. I'm one of the founding partners of Basepoint Wealth, and I will be acting as the facilitator today for this conversation. Our speaker that I'm going to turn this over to in just a moment is Alan Wallace, our Chief Investment Officer. Alan has been in the business doing what he does for a little over 20 years. He was one of the lucky folks that started his career back in the year 2000, right about the time that markets went through some circumstances not too dissimilar to today. So he's been around for quite a while and has seen a lot of things, brings a lot of wisdom and insight to the process that guides our team with respect to investment management. Alan is married to Kate Wallace, president of Basepoint Wealth, and resides here in Iowa, in Marion, so a local resident to the firm. So as we get this kicked off, Alan, as you're kind of getting spooled up over there, I think it makes sense today to kind of dive right into what folks are probably here to really hear first and foremost about, which is some thoughts about what is really going on in the investment world today. Obviously, the last year or so, last couple of years really post-COVID have been really interesting, to say the least. So why don't we start off by kind of diving in? And I know from prior conversation with you, really what you're going to focus on here initially is four underlying themes that are omnipresent as we turn the calendar from 2021 into 2022. And for those who have kept up with our newsletters and other communication or perused our website, many of these things are things that you've written extensively about. And I would encourage folks on the call today to take some time on our website under Insights to see some of the things that Alan has written about on these topics. But really, as we come into 2022, looking at these four major areas, inflation and the Fed's response to it. Obviously, that was top of mind today with another testimony from Jerome Powell in front of Congress, talking a little bit about what you're seeing as far as maybe what you classify as a valuation disconnect, how that's weighted a bit in terms of what folks are seeing on their screens each day due to market cap weighting effect on our indices, and then maybe a little bit about what's really happening beneath the headlines that a lot of folks may not be paying attention to. And I know you like to use the term being able to differentiate between signal and the noise. And so maybe you can talk us through this a little bit about what you're seeing out there.
Thanks for the introduction, Landis. First of all, let me wish you all greetings from the frozen tundra of Cedar Rapids. And to all you expatriates sweating in Florida, all I can say is I hope it isn't too hot for you down there. So with that in mind, let's start this off with a quote by Elroy Dempson, who said that risk means that more things can happen than will happen. And when we're trying to look at the present situation, we're trying to take a gauge at what we expect has happened in the past when the situation was similar. Another quote from Churchill was, the further you look in the past, the further you can see into the future. Now, we're very humble in this regard. We don't think that we can predict the future, but we can take a very good look at where we're at, and we can gauge the risks, and we can make a bet on whether the downside risks outweigh the upside risks. And so that's the sentiment I want you to take in with this conversation. But where we're at now is that we have large liquidity flows from both monetary and fiscal policy. Monetary policy is what the Fed does, and fiscal policy is what Congress does. And we can look back at history all the way back to 1708 when John Law went to France and see what happened when monetary policy was extreme. And most of you know that ended in the beheading of Louis XVI about 100 years later. And that's the other thing that's important to know, is that these things can take lifetimes to play out. And so it's one thing to be right about the eventual outcome of something, but the problem is the timing. It can last several lifetimes. So what we're seeing is that due to the liquidity situation, inflation is starting to finally pick up. And if you look at the little chart at the bottom, you'll see that inflation hasn't been this high going back to 1990. And in 1990, it was only about 10 basis points higher than it is now. To get real inflation, you have to go back to closer to 1980. And what you have is you have an investment industry that's populated by analysts who haven't really seen this type of situation before, and that can be a dangerous situation. So what we know from history is that when inflation picks up, it normally leads to increased interest rates. That's very intuitive. If there's inflation, then people demand higher payment in order to let someone else use their money. I mean, that's common sense. And we always like to say, why use math when common sense will do? Increased interest rates normally lead to lower bond and stock prices. That's because the inverse of the price is the return that you're getting. And so when rates rise, it acts like gravity on the price of assets. And so if we look at every inflationary period going back 400 years, that's really the way that the world has worked. The little gray chart at the bottom will show you that when we go through periods of inflation, we typically have a pretty large correction in equity markets. The one exception was March of 1980, where the market was flat. But we had already gone through over 15 years of sideways equity returns. And then you have the current cycle, which you can see here, where we have 6.2 inflation and we have a 40% gain in the markets. And that's definitely an anomaly. That's not something that we've ever seen in the previous 80 years of history that we're sort of tracking here. And again, that doesn't mean that we want to liquidate securities or try to predict the future. It means that we want to take a clear look at where we're at now. So where is the market as far as valuations are concerned? This is what we want to think about. We never think about timing. We can't time the market. John Maynard Keynes said that the market can remain irrational far longer than you can remain solvent. So we want to look at the pricing of the market. So if you look at price to sales, in other words, how many times sales is the market trading at? We're at 3.17 right now. That's the highest it's been. It's actually higher than where it was in the tech bubble on the S&P 500. Now the Nasdaq was much higher than that back then because that was the investment du jour. But trading at 3 times sales is an extreme market valuation. Our earnings yield, which is the inverse of our PE ratio, is at 3.42. We're getting somewhere north of 2% on a 30-year treasury. We're not getting paid that much to take that equity risk. Now, again, we're looking at the S&P 500, not the portfolio of securities that we have you in. We try to look at individual securities and build portfolios from the bottom up. We don't look at indexes and try to buy top down. The Shiller PE ratio, which looks at the last 10 years of earnings, is at 38.95. The only time that was ever higher was in the tech bubble. And so let's just take a minute to think about, okay, what is the S&P 500? We know it's a group of 505 stocks, but you would think intuitively that that's equally weighted. In other words, you have a 0.25% in each of those stocks. But if you look at the components, you see that the top 10 holdings make up 30% of the index. And 8 of those top 10 holdings are technology stocks. Technology stocks tend to be highly levered to interest rates. When interest rates rise, technology stocks normally drop. We had a good test case of that this week. Interest rates rose. The 10-year Treasury went from the 1.4s to the 1.7s, and you had a 7% correction in the NASDAQ in the last 10 days. So while I don't put any faith in 10-day performance, we did get a nice little test case at how things should look when the rates start to rise. Let me clear my annotations off here. So market cap weighting is sort of a weird thing in that it has a momentum factor built into it. In other words, the larger a company gets, the bigger the percentage of the index it is, and so the more prevalent its performance is on the rest of the index. But those other securities in the index are telling a different story. As of December 10th, there were 5 technology firms which accounted for more than half of the 12% return since the end of April, and 1/3 of the 26% year-to-date gains through December 10th. That's an amazing statement. So what you have is you have several very large companies that are driving the returns of the entire index. A little bit of an updated figure that isn't on this slide because it's as of yesterday. 40% of the securities in the NASDAQ are down 50% or more. And so that's an incredible statistic. Most of the securities in the NASDAQ are down. 2/3 of the securities in the NASDAQ are in a correction. But the index itself is within 6% of its record highs. So when you look at the news headlines, you see markets at all-time highs. But when you look at the components of the indexes, you see these companies that everyone's heard of, DocuSign, Avis, Zoom, Zillow, they're down 52 to 78%. That's an incredible correction. Keep in mind, if you lose 80% on a security, you need a 400% return in order to make that back. That's an incredible amount of time. And something a little bit new here, you can see that we're in the top 13% of all days since 1999 with securities down 50% or more in the NASDAQ composite right here. There's only a few other times in recent history where the NASDAQ has been down more than it is right now. So,
thanks, Alan. So as you're kind of outlining that for everybody, obviously this past year, and like you said, really it's kind of extended back even longer than that into 2020. It's really obviously been a year of a lot of turmoil. There's a lot of data points out there that are increasingly making it challenging to really know what's real and maybe what's a headline, what's really happening. And as you noted earlier, there are very few investment managers in the business today who are alive, let alone managing money. The last time many of the market factors you outlined were present. Really, it's dated back over 40 plus years ago in many cases. So with that in mind, and knowing that you're kind of a student of history in a lot of regards here, what are you and your team here doing currently? And what's this experience been like for you over the past year or so? Well,
as you said at the beginning, I sort of started my career in a situation similar to this. And what I've learned over those years is that permanent losses are so much more impactful to your success than market gains, that we have to clearly know when it's time to worry about return of capital as opposed to return on capital. There's a really big misconception in that stock markets are kind of like coupons that you clip, right? Like a bond. So you own a bond and you get $60 in interest and you put it in your pocket and you can go spend that. Stock returns aren't like that. Stock returns are a stochastic system and they're continuous. In other words, the returns can be equally negative in a future year than they were in a previous year. So you have to sell in order to realize a gain on a stock, where that's not necessarily true when you look at a bond. So just to sort of think about why we focus on hitting singles, if you look at the spreadsheet chart that we have in here, I show what it looks like if you have a 6% return for 9 years and a 12% return for 9 years. You'll see that the 12% return greatly outperforms the 6% return. But what if the 12% return was earned because you were taking some sort of risk that eventually turned against you. And you can see that in year 10, with a 50% loss on the 12% side, your returns in the 6% series are actually greater. And I can think of no better example of this that you can see as the ARC funds, that were up so much over the last 4 years, and then they've underperformed the last year or two, and their investors are now actually net negative from where they started. So you had an extraordinary rise, and then you also had an extraordinary fall. There was this thing called the Trinity study that looked at what distribution rates do to your probability of success. And that's really what we're most concerned about here. We're concerned about making sure that your money lasts for the rest of your life, and in a lot of cases lasts for your children's lives. So we're not comparing ourselves to an index. We're comparing ourselves to what you need in order to meet your success. And if we think about distribution rate, which is the percentage of your portfolio that you're taking out on an annual basis, the Trinity study showed us that if you're in a portfolio of 25% stocks and 25% bonds and 75% stocks, at a 4% distribution rate, there's a 92% probability of success. That's an extraordinarily high probability of success from a single point in time that we can make adjustments for over the remainder of your life. If you think about the way that the rule of 72 works, if you get a 50% loss, that basically cuts back the last 10 years of returns at a 7.2% rate of return, which is approximately what we expect in equities. And if you lost 50% of your assets, you would basically increase the distribution rate of 4% to 8%. And what we see is that at an 8% rate of return, your probability of success drops all the way down to 6%. So protecting what you have is much more important than eking out an extra couple percent returns in a very short period of time. So let's think about what our positioning strategy is. We have to look at what the real market conditions are. And we have to look at the things that influence those market conditions, whether it be the Federal Reserve or whether it be the news. These things can often deviate for weeks or months or even in some cases years. There's a quote by Lenin where he said that there are decades where nothing happens and then there are weeks where decades happen. Well, we had a couple of those weeks in 2020 when the COVID thing first started to make itself known, where we had an extraordinary market drop and then we had an incredible market rise. And we had ourselves in a position at the time that was able to take advantage of that. But what we're looking at now is we're looking at inflation, which is the first that we've seen since 1990. We're looking at very high valuations on the level that we haven't seen since 2000. And we're looking at the Federal Reserve starting to try to get out ahead of this. One statistic that may hold true or may not is that there's typically a recession within 24 months of when the Federal Reserve starts raising interest rates. It's a virtual certainty that the Fed is going to start raising rates this year. The argument right now is it going to be 3 rate increases or is it going to be 5? So the clock is ticking on that potential recession from changes in monetary policy. The market is a forecasting mechanism. It doesn't react to things. It typically forecasts things. And so the market typically starts to adjust 12 to 24 months before a recession. So the way that we're positioned is that we have more cash than usual, just in case that there's a market drop, so that we can, and to maintain liquidity. So if you have expenses that are coming up, you need a new vehicle, you have that dream cabin that you want to buy, we want to make sure we have plenty of liquidity so that we don't have to ever sell assets at an inopportune time. We're focusing more on, we're focusing less on domestic equity because US stock prices are significantly higher than the rest of the world. If you look at Europe, if you look at Japan, the prices there are significantly more reasonable. So we've increased international exposure because the US is printing so much money and because the international valuations are better. On the bond side, and if you look at how bonds have performed year to date, intermediate bonds are down about 3%. And so if you think about that in terms of a 30 basis points increase in interest rates has caused almost a 3% decline in the prices of those bonds. Think about what it looks like when we're at 3%, 2.5% on the 30-year treasury versus 6% inflation. the downside potential in fixed income is one of the most underrated things in the current market, and it's one of the reasons why we've avoided any sort of interest rate risk over the past year or two, because we just don't know when interest rates are going to start to rise. But we have very short-term, high credit quality bonds because A, interest rates are low, and B, because the credit spreads are very tight. Credit spread is the difference between a risk-free bond like a treasury and a corporate bond. So when spreads are tight, there's very little potential for increases in corporate bonds. So we try to limit exposure to credit spreads when they're tight. We've also increased alternative exposure because stock and bond options are limited. So we have some strategies that are diversified. We have some merger arbitrage stuff. We have things that are long short, so that the fund manager can decide to sell stock short or go long on those stocks. And then we also have some exposure to precious metals, which we don't think of as short-term investments. Precious metals have typically kept up with inflation over long periods of time, but in the short term, they're highly volatile. So we don't want to think about the fluctuations in those assets. We want to think about the goal that they're fulfilling within the portfolio. We also have the energy exposure. There are great energy input shortages in Europe, and for the first time ever, energy is less than 2% of the S&P 500. That sort of tells you how hated that sector has been. But if we look at how we performed even year to date, so we're on January 11th, year to date, our energy positions are up 7%. Now that's a brief look at what happens when interest rates start to rise. And I hate to talk about short-term performance like that because we never want to judge what's happening in your portfolio based on that short of a time period. But if you look at what the different levers in the portfolio did, we're very pleased with how things played out over the last couple of weeks. So if we look at 2021, we want to think about how did the way that we were positioned impact the returns that we had? Well, obviously cash was a drag on returns because technology continued to rise and cash was paying very low returns. We expect cash returns to increase as the Fed starts to increase interest rates. That's a great advantage over bonds, which decline in price when interest rates rise. Cash does not do that. But a drop in interest rates between June and December, and we were positioned for rising interest rates. If you look at our performance last year, most of our returns came from January to June. And then from June to December, we were relatively flat. And that was typical of most investments that weren't the S&P 500. So out of 41,000 global stocks, if you took out the top 300 US growth stocks, the return on the index was about 1.5% for the year. And we did much better than that. Our average portfolio performance was somewhere in the 7 to 9% range for any clients that were invested from January 1st all the way through December 31st. Our alternatives, especially silver, detracted from returns. Silver is very volatile. One of the biggest issues with silver is that the paper market for silver, the futures market, is almost 100 times the size of the actual physical market. One of our investment theses is that if the holders of physical silver ever actually demand delivery of the physical commodity, the price has an incredible opportunity to rise. And so our exposure to silver is actual bullion. It's a fund, but all it is they hold bullion in the Royal Canadian Mint. So it's not here in the US, it's in Canada. And we can actually demand physical delivery if we want to. Our equity performance last year was actually very good. Most of our large cap funds actually outperformed the S&P 500, believe it or not. We just had less allocation to equities than usual. So the overall performance looked low in comparison to the S&P, but if you look at just the equity performance, it was actually quite good. International equities did underperform US large cap growth last year. So international equities were a drag on performance. The energy exposure that we had did increase volatility of the portfolios. The price of oil and coal jumped around quite a bit last year, and so that did create more volatility in our portfolios. And our bond allocation has been flat to slightly negative due to interest rate increases at the beginning of the year. So what we're looking at going into 2022 is that we do feel like we were positioned correctly. We can't let the outcome determine whether we were positioned in the right way. If circumstances told us that something was likely, If the weatherman says there's a 90% chance of rain, but it doesn't rain, that just means you fell into the 10% range of outcomes that didn't include rain, but it doesn't make it a wrong forecast. 2022 looks set to deliver what 2021 looked to deliver. And part of the biggest reason for that is that we had this denial from the Fed that there was inflation. So if you look back at June, the Fed said there wasn't inflation. You go into August, they said, well, yeah, now there is inflation, but it's transitory. And now you look at where we're at in January of 2022, and they're saying, oh yeah, there's inflation, so we're going to start raising rates. So part of the issue is that the Fed speak sort of can drive equity and bond markets in the very short term. They won't be able to do that over the longer term because the market forces will overpower. But in a 6 to 12 month range, what they think will happen may actually drive returns a little bit. The vast majority of our clients are positioned to be aggressive when equity prices drop. It's never right to be all cash or all equity or all any sort of asset class. We have equity exposure in the right position and in the right securities, so that if there is an equity correction, your chances of success are not going to be limited over time, and we have sufficient cash and alternatives to move into equities when the prices are down. And then also patience. Tolstoy said that the two most powerful warriors are patience and time. Time on its own is a poor soldier. We need to also be patient, and we need to remember that these are decade-long cycles that we're dealing with, and we can't look at 3 or 6 month performance in order to determine whether or not we're positioned in the right way.
Great, thanks, Alan. Really appreciate that look at both the investment climate currently, as well as some thoughts around what you and the team are doing specific to the management of money here at Basepoint. With that concludes our core presentation. So I want to go ahead and transition us over into the Q&A period. Just as a reminder from what Katie mentioned earlier, at the bottom of your screen in Zoom, you should see a Q&A icon that will allow you to type questions in that then we can address here. Before we do that, just a few reminders to those participating. Using that Q&A feature at the bottom of your screen in Zoom to submit questions in writing. And then, of course, because of client privacy requirements, we can't address client-specific or account-specific questions in this forum. However, we do welcome those questions about your personal account, and we'll address those individually outside the webinar. So certainly feel free to reach out to your advisor with any personal questions related to your account. So Alan, I've got a couple of questions that are coming in here already. So let me start off with one. It says, looks like Basepoint currently is carrying a lot of cash in its models. Today, cash is having a hard time keeping up with inflation, which I think you mentioned. Is carrying so much cash a concern for performance? And the follow-up to that, at what point will a market correction cause Basepoint to put that cash into the markets?
Sure. So I look at cash as a call option on future equity purchases, and then also as a place to keep liquidity. The other interesting feature of cash is that as the Federal Reserve starts to raise interest rates, cash rates will go up. So if you look at what you could get on a CD in 1982, it was like 14%. So now it will lag inflation, especially when there's denial that inflation exists, like there was over the past year. But if we're sitting in bonds, we could take a 20 or 30% decline as rates rise. Cash doesn't do that. So I'd much rather lose 3 or 4% to inflation and then be able to buy equities at a 40% discount at some point over the next year or two than to put all that money into equities in the hope that they hedge us against inflation. With that in mind, this isn't a permanent allocation. We're as far to the left of the equity allocation as we've ever been, as far as being smaller, and I don't plan on doing that for very long. Buffett has said that 90% of the time the market trades in a zone of reasonableness, and as the charts earlier showed, we're well outside of that. We're outside the valuations that we were seeing in 1999. But the equities that we are buying are fairly reasonably priced. So, we don't own those overpriced tech stocks. And you can tell that that's true because even though 50% or 40% of the NASDAQ is down 50%, our equity allocations are actually up year to date.
Perfect. Next one I have here, and this maybe kind of dovetails, you talked in there a little bit about, and I know you mentioned several times throughout the presentation, past, relying on history a bit to think about what's going to come in the future. And one of the questions here sort of has to do with maybe something that's a little unique about this circumstance. It says, with the flood of money into the economy, are the traditional thoughts or thinking around impacts of rising interest rates, for example, necessarily going to hold true moving forward?
So I'm looking at 400, 500 years of history. And so yes, I mean, if you go back to the early 1700s, where when John Law went to France and said, hey, why are you guys using gold as currency? Why don't you just print money? It worked a certain way. If you look at when the Continental Congress printed money going into the Revolutionary War, it acted a certain way. If you look at when the Confederate States printed money during the Civil War, it worked a certain way. And it's really a law of physics. And imagine you're playing a game of Monopoly and someone else goes out and buys 10 board sets and comes in and just injects all the cash from the other games into yours at once. That's a very small diorama, but you can see how it would impact the prices of the activities. So yeah, I have high confidence that even though we can't predict the timing, the outcomes will be the same.
Perfect. Couple questions here, maybe related to areas of possible opportunity going forward, and I'm going to take a couple and kind of push them together here. So, first part, you talked a little bit about use of oil and coal for some of the energy exposure. There was a question in there of whether you view there being possible opportunity in renewable forms of energy in addition to the traditional. And then kind of as an extension on that, beyond just energy, are there any other sectors that you're specifically looking at as possible opportunities, either tied back to congressional action like the infrastructure bill or otherwise?
Sure. Yeah, our preference for oil and coal right now is purely based on valuation. The fact that that those commodities have become cheap because they've been so hated. You have a lot of the oil companies have suspended capital expenditures in those areas, which is only making the prices go up. And then we just don't have the infrastructure in renewables to run our power grid. I mean, if you look at what happened in Texas last year when the windmills froze, or you look at the fact that California has these restrictions on how much renewable energy they have to use, and instead what they're doing is buying power from Nevada, who doesn't have that same restriction. You look at China, who's building coal plants as we speak, and we're still short of those inputs. And part of the reason is because capital didn't flow into those areas, and our infrastructure was still tied to them. We have this push right now to go to electric vehicles. Well, they run off the power grid. So if you're gonna convert 30 million vehicles to electric, you're gonna have to produce enough commodity to produce that power. Simultaneously, you've got the Bitcoin mining moving to the U.S., especially Texas, ever since China outlawed it, which is also putting pressure on the Texan power grid, which, by the way, almost shut down last winter. So that's why we're focusing on that area. It's purely based on valuation. But if renewables were cheap, yes, we would absolutely go into that area. They happen to be expensive, though, because they've been surviving on government subsidies for the last decade.
Perfect. I've got a question here. This is kind of timely, I think, given Powell was in front of Congress again this morning. Question is, both Jerome Powell as well as Kathy Wood, the purveyor of the ARC funds that you mentioned earlier, have both stated that they believe the inflationary period right now is temporary, and there may be a period of deflation in the future. Do you agree with that sentiment? And if that type of an environment did unfold, what could that possibly mean for the investment outlook moving forward?
Sure. So there's a lot to unpackage in that question. The very first thing we need to do is differentiate between asset inflation and deflation and goods inflation and deflation. Monetary policy causes asset inflation and deflation. Fiscal policy typically causes goods inflation and deflation. Over the last decade or more, 15 years, we've had significant asset inflation because we've had monetary policy procedures that have been expanding the money supply. We finally started printing a lot of fiscal money over the last 18 months due to the COVID crisis, and that's what you're seeing trickle down into the goods inflation area. The sort of ugly thing is that the asset inflation and goods inflation are kind of opposites. So you had deflation when you had asset inflation, but if you have goods inflation, you're typically going to have asset deflation. And in layman's terms, that means the price of your assets are going to go down. And that's what we're worried about. And it goes back to that slide about your distribution rate. Agreed. I can't calculate the probability that this inflationary trend is transitory and that there's going to be deflation next year. But what I can do is protect your assets in case it does. Because if there is deflation, then we're still going to be okay because we have cash, we have bonds. Some of our stocks might suffer a little bit, but we have alternatives. And so we're in one of those positions where we have to ask ourselves, is return on capital more important or is return of capital more important? And again, going back to that distribution rate thing, return of capital is much more important in this type of environment.
Alan, you used a couple terms in there that I know have been floating around a lot, and I want to take an opportunity. Could you maybe talk just real briefly, as folks are watching the news or reading headlines and we hear things like transitory inflation or asset inflation or deflation, what have you. It seems like there's been maybe a little misuse of some terms or some conflation of terms. Could you talk a little bit about the difference between transitory inflation and snapback inflation?
Well, sure. Transitory just means that it's going to go back, go away. So, we had 6% inflation, and then next week we have 3% inflation. And that may be the case. Snapback inflation means we have 6% inflation, and then we have deflation next year that gets rid of the 6% inflation. And I think most people think that's what they're talking about, but it's not. What they mean is the prices are at a new permanently higher level, but they won't go up as much in the future. That's what transitory means. But this idea that prices went up 6%, but they're going to go down 3% next year to pay you back for the inflation that you had, that's not going to happen. It's too difficult to roll back prices both in wages and in goods markets. I mean, how many times have you seen the price of crackers drop 3% in the grocery store, even over your lifetime? It rarely happens.
Great, thank you. I've got two more questions in here that have come through. One of them maybe has a little bit more to do with how Basepoint is set up with respect to the relationship between our advisors and your team. And I think it'd be good for you to kind of maybe address this. It says, how much flexibility do individual advisors have with regard to following or deviating from the portfolio investment strategy or positioning that you've outlined here today? So maybe the way to approach that, Alan, is talk just a little bit about the relationship between the advisors, what they're doing with clients, and how they're communicating information over to your team, and how you guys are then putting that into effect.
Sure. Yeah. So from our perspective, we are the employees of clients. We don't dictate our policies. What we do is we make recommendations. And so advisors have ultimate flexibility to cater a portfolio so that it's in line with the client's goals. So if you say, hey, I don't like oil, so I'm not going to be in oil, we remove it from your allocation. Our software, when we rebalance, will let us know that this client doesn't invest in that area. Now, that may hold your performance back. And so we want to let you know that, when we talk about performance, we say, well, there were some restrictions on here that caused us to perform less than what you would have if you were in the company model. But the role of the advisor is to determine with a client what their constraints are and to build a portfolio that is suitable for them. Now, with that said, we are fiduciaries. We have to make decisions that are in the absolute best interest of the client under all circumstances. And if we feel like you're saying, I want to trade tech stocks in my account, we just may not be suited for that. So there's a difference between catering a portfolio and versus operating a trading strategy that's sort of out of line with our core principles.
Great. Thanks, Alan. I've got another one here. This one kind of maybe goes back to your question on, or your statement on asset inflation and deflation. It has to do with real estate. It says, to the asset inflation deflation point, do you have a position on the real estate market and the inflated values that we're seeing here recently? And then crossing over a little bit, maybe to the investor side, what's the view on REITs or associated types of product mechanisms for investing perhaps into real estate exposures?
Sure. So we will invest in real estate over time. One of the issues right now is that real estate is priced based on what are called cap rates, and that is the yield that you earn on the property. And when interest rates are low, cap rates are also low, and when interest rates rise, cap rates rise, which acts sort of the same way that it would on a bond. So when the cost of financing starts to increase, which we had a huge spike in the last week or two, the price of the real estate inevitably has to come down in order to adjust for real estate prices. So those of you who are over the age of 50 or 60 and you bought your first house during periods of much higher interest rates, you'll remember that the prices were lower proportionally because you had to pay 7-8% in order to get a mortgage. Well, when interest rates are when mortgage rates are 2% or 3%, you can buy a lot more house. So prices rise in order to sort of create the supply and demand equilibrium.
Thanks, Alan. And that actually spurred a follow-up question here specific to real estate. Do you have any thoughts on the current property crisis unfolding over in China? And as beyond that, do you feel that situation may have any immediate or long-term ramifications to some of the international exposure that you mentioned earlier in the presentation?
Well, first of all, we removed all Chinese exposure about 2 years ago, and it was political in nature. And what we saw here was an exact reason for why we did that. If you look at the Evergrande issue, they basically threw non-domestic investors under the bus and made domestic investors whole. And they have that option, right? So one of the major risks of international investing is political risk. So you look back during the pandemic, you had countries like India and China saying, well, we're not going to export. You can no longer export the inputs that you use to make medicine. That could have become a huge issue in the US because most of the inputs that we use to make our medicines are not made in the US anymore. 90% of them are made in foreign countries. So it's more of a political risk issue than it is a pricing issue. But we've been reading about China building ghost cities for a decade, right? One way for them to keep their GDP increasing is to build things that they don't need, because the problem with GDP is it doesn't take capacity usage into consideration. It just, if you spend money, you build something, it counts as part of your GDP. Well, couple that with the fact that money has been sort of easy over there, and there's been a lot of foreign capital flowing into the country. You get a situation like this where the real estate market is incredibly overvalued. But again, I think the biggest lesson from there is the fact that there was a very clear dichotomy between how they treated domestic investors and how they treated non-domestic investors. And that was one of the main reasons why we eliminated our exposure to China about 18 months ago.
Perfect. And Alan, one final question here, unless something else rolls in on me. It's not unrelated, I guess, to something you talked about there. What are your current thoughts relative to the ongoing COVID and the current Omicron situation and any potential impacts to supply chain, whether you view that as a potential risk to the domestic economy or the international moving forward.
I'm sorry, the question was about supply chain?
Yes, sorry. Thoughts around the COVID Omicron outbreak and whether or not you view potential ongoing risks to the global supply chain as a risk.
Well, so one of the first risks that we pointed out when we wrote about COVID before it was even really a thing in March of, was it 2020? I laid out what I thought the risks were, and the third one I said was supply chain issues. You know, we are a global economy that is all tied together, and that will continue to be a risk. But it appears that as far as things like food and medicines, we've done a good enough job of continuing to get things imported. There were there are shortages in stores right now, and that may continue to happen, and that will contribute to higher inflation. But I don't see yet that it's in a catastrophic point, and I think that that part should work its way out over time. But as monetary and fiscal policy continue to expand, you will continue to see inflation. It may not be directly related to the supply chain, but so I would separate supply chain dynamics from inflation, even though most of what you read in the media is blaming the transitory inflation on supply chain issues. Now, one big issue is that we don't have sufficient truck drivers. And so that would be where I would focus the majority of my attention, especially as vaccine mandates continue to expand in the West Coast. But something like 30% of all of our goods are offloaded in the port of Los Angeles and other areas around there. And the rules in California have gotten to the point where there's truck drivers waiting on the border in Nevada for the few that can operate in California to get there. So that has actually caused quite a bit of the supply chain backup that we've seen.
Great, thanks, Alan. And I did have one last question roll in here, and I think it's probably one worth getting to. Has increasing scrutiny related to corporate ESG and sustainability practices impacted which companies you choose to invest in?
I'm sorry, you read that so fast I missed it, and I apologize.
No, that's okay. Sorry, I'll slow down. Has increasing scrutiny related to corporate ESG and sustainability practices impacted the companies that you are evaluating or choosing to invest in or avoid?
Not really. One of the problems with the ESG movement, and I've been watching this for a decade or more, and at the CFA conference this year, it was all ESG. And so part of the issue is whenever you slice off another category and it has wide adoption, it has a tendency to become overvalued. You can go back to the Nifty 50 in the 70s and the same sort of thing happened. So it's not that I'm anti-ESG. I think that's great. I think and individual clients, we have several clients that have ESG restrictions on their accounts. We don't disagree with that, but on a firm-wide basis, the majority of our clients have said, I want you to protect my money and make the most return that you can over time. And my fear is that putting those type of restrictions or buying into an index that's solely going up because of demand is going to create excess volatility over time. And if you look at what's making up most of these ESG portfolios anymore, it's the same names that are in the S&P 500. ExxonMobil's in there because they've agreed to limit capital exposure to future oil drilling. So, I mean, it's really become an area that is not as pure to the roots as people would expect it to be.
Great, thanks for that, Alan.
And Landis, I saw one other question that I do want to answer. Someone asked a question of, is a recession inevitable?
Yep, sorry, I missed that one.
That's okay. And to that, I will say, yes, it is. The problem is I don't know when. So, as I used the Keynes quote earlier, I said the market can remain irrational far longer than you can remain solvent. So, yes, a recession is inevitable. Now, historically, within 24 months of the Fed raising interest rates is when it has happened. So if you look at the probability, we're somewhere between 12 and 24 months from a recession. Doesn't mean it has to happen, but we are positioned. And again, we're still trying to earn the highest rate of return we can get in a manner that protects your capital. I don't want you to feel like we're hiding or we're not putting your money to work. We judge what you need based on your financial plan. If you need 6% to have a 92% probability of your money lasting the rest of your life, that's much more important to me than saying, well, we need to be within a hair's breadth of the S&P 500, especially if it's an extraordinary risk in order to get those type of returns. So our goal is to protect your capital and to get the highest return possible with rule number 1 still in mind.
Great. Thank you, Alan. And with that, we will go ahead and conclude this webinar for today. Again, we want to thank everybody who joined us for this session. And as we mentioned earlier, if you have individual follow-on questions or questions related to specific things about your account, please do reach out to your advisor. They'll be happy to address them and or connect you with Alan and his team as appropriate. We wish everyone a wonderful Tuesday and best of the rest of the week. Stay warm, stay safe, stay healthy.